What up, everybody? I hope everybody's doing well. I want to go through some crypto news since the new year. There's been a lot that's happened. We do have still the pump going on that I announced on the 1st. It's been 10 days now. We're going to have the 11 days if it holds tomorrow when you see this. And a lot has happened. We have the New York State Attorney has filed against Celsius CEO Alex Mashinsky, Sam Bankman-Fried, saying that he deserves to have the Robinhood shares and the money, not you. Bahamian liquidators news, SEC and crypto regulation news in the US. There is information with Genesis and DCG. We have on-chain data, which I'll put at the end, the last part of the video. And let's look at a little bit of crypto TA and then we'll get into the news. So, I had put in my last video title, Bitcoin to 20K question mark. Now, we've come up a lot and we're still rolling. We're at 17,446 at the time of recording this video, and we do have a big sales wall around 17,600. So expect resistance. I don't know if we'll have enough buyers to push through and break out or if we'll reject, but we have made a lot of progress on all cryptos. Ethereum's looking good. Matic has made major moves. I'm looking at the hour just so you know. If you're not familiar with my chart indicators and settings, you can come in the Discord. We have a link below. We released an early beta version. We will release updates as we go for subscribed members and people that we pick for beta teams to test on it. People are already testing on it. There's going to be a lot more updates and tweaks, but all my videos, I usually mention it, but there's over 100 indicators, lots of calculations going on behind the scenes. We get very, very high win rates consistently, all market environments, all phases, cross assets. So it's pretty sick. I've been working on it for a long time, and my partner has been lacing up the coding for us, and we're not quite there where I want to be, but we're getting closer. And we wanted to get it in people's hands so they could try it. So yeah, look, you can see Matic has hit the pivot. You see where it goes from pink to green. There's the pivot. It established a floor, and boom, off we go. We're at 86 cents. Bitcoin, on the hourly, you can see, that's the FTX dump. Went sideways, kind of fell down a little bit, and it's just rallying up. This is good. Ethereum has looked wonderful. There's the FTX, and boom, look at that go. That looks really good. And if you look at these things on the daily, they're actually picking up some really nice steam. Look, you got the Jedi green light still under the 200, but you're out of the descending. You do have the green lights. You have maybe found a floor. It looks positive to me, guys. It really does look positive. I'm not saying it can't go lower, but it's tradable, and we've been trading it in our Discord, and I've been trading it personally. A lot of people have been trading, and it's been going really well. Now Solana has really moved up. It got as low as about $8, and it's doubled. It's at $16 right now, and I think it got up to 17, maybe 17 or high 16s. But looking good. Doge moving up as well. Avalanche, everything looks good. It's not where it was a few months ago before FTX, but crypto's holding pretty well. Stock market is on a little short rally as well, and we're getting some of that money back if you're in the hodl and you're in the investment, and it's been great to trade the momentum. It's been nice to actually be able to trade. So I've been trading really hardcore every day and putting in big long sessions, and I've been really happy to do that. It's made me feel good to be able to trade. Look at Ape, guys. Ape is just moving up like really big. These are nice oscillations, higher lows, higher highs. It's just moving up. Look at the daily. Same thing. It's pretty much, you can just see the chart. It kind of bottomed. There's the Jedi green lights, and it's on approach to come out of the 200. If you break out of the 200 with the price action, you move out of phase 4 into phase 1, the beginning of the bull run, or better said, the beginning of the accumulation phase where smart money tends to buy or is trained to buy. Usually retail is gone. That's why there's not that many people probably watching right now, but hey, you're hardcore and you have thick skin, and I love that about you. And yeah, let's take a look at some of the news. Link is in the description for the Discord if you want to try the indicator and you want to come in. We got a lot of people in there talking, chatting, showing charts, helping. We have a Jedi simulator where I'm giving away $5,000 for the winner at the end of the year. So join that. It's free. You get $1 million to trade. It's simulated money, and you also get 100 grand to trade crypto for fun and just kind of practice and whatnot. So yeah, stock market looks good. Most stuff's green. Crypto looks good. If you wouldn't mind, hit the subscribe, the like. We do have a Twitter, an Instagram, and of course the YouTube. So smash that like. It's right under the video. Let's take a look at some of the news.
Stories first. The SEC and the Department of Justice's Eastern District of New York are reportedly looking into transfers between Digital Currency Group and its Genesis subsidiary. Citing people familiar with the matter, Bloomberg reporting that prosecutors have requested interviews and documents from Genesis and DCG, and that the SEC also seems to be in the early stages of its own investigation. The report indicated that Genesis and DCG have not been accused of wrongdoing. We reached out to both agencies, and an SEC spokesperson told us that the commission, quote, does not comment on the existence or non-existence of a possible investigation. A spokesperson from the DOJ's Eastern District of New York said no comment. A Genesis spokesperson, meanwhile, told us, quote, while we do not comment on specific legal or regulatory matters, Genesis maintains regular dialogue and cooperates with relevant regulators and authorities when it receives inquiries. DCG told us that it has a, quote, strong culture of integrity and has always conducted its business lawfully. The group added that DCG has, quote, no knowledge of or reason to believe that there is an investigation into the company. The lending arm of Genesis was hit hard by FTX's sudden collapse and halted customer withdrawals. The freeze is still in place. DCG has reportedly said that it has not been impacted from the issues at Genesis. Next, the Robinhood shares linked to FTX and worth nearly $500 million have now been seized by the Department of Justice. That's according to this court document filed late on Friday. The DOJ confiscated more than 55 million shares owned by Sam Bankman-Fried and his FTX co-founder, Gary Wang, through a holding company, writing in court docs that, quote, the seized assets constitute property involved in violations of crimes including wire fraud and money laundering. SBF was charged last month with those crimes and others. He pleaded not guilty last week. Wang did plead guilty for his involvement and is cooperating with prosecutors. Last week, SBF argued that he should keep control of the Robinhood shares, disputing a claim by the bankrupt exchange he used to run. According to court filings, 3 parties have now tried to get control of those shares, including bankrupt crypto lender BlockFi, an FTX creditor, and Bankman-Fried himself, who indicated he wanted to use those shares to cover the cost of his legal bills. In this court document filed last month, FTX argued the shares should be frozen until they can be divvied up fairly among creditors. SBF rejected that idea in his filing late last week, arguing that he and Wang legitimately bought the stock using money borrowed from FTX's trading arm, Alameda Research. Last up, the FTX bankruptcy team in the U.S. has agreed to work with the liquidators in the Bahamas, where the crypto exchange was based. That's according to a joint statement put out on Friday, where the two sides said that they will work together to share information, secure property, and coordinate litigation against third parties. Competing bankruptcies were filed in the 2 regions, putting the bankruptcy team in the U.S. and Bahamian officials at odds since FTX's collapse in November. The development settles the disagreement that threatened the recovery of what could be billions of dollars in lost funds.
Next, more layoffs facing the crypto industry amid the downturn. Crypto exchange Huobi told Reuters it plans to cut its staff by about 20% because of the, quote, current state of the bear market. In a tweet today, blockchain data firm Nansen said that in the last 24 hours, the crypto exchange saw a, quote, significant increase in net outflows. Earlier this week, we told you about crypto firm Genesis cutting 30% of its workforce in a second round of layoffs in less than 6 months. And just yesterday, we also told you that crypto-focused bank Silvergate cut 40% of its staff after reporting a sharp drop in its fourth quarter deposits. Last, New York Attorney General Letitia James sued former Celsius CEO Alex Mashinsky yesterday, alleging that he defrauded thousands of investors. The AG claims Mashinsky lied to investors about the extent of losses when he was CEO of the now bankrupt crypto lending company. Mashinsky publicly assured customers that investing with Celsius was safer and more lucrative than leaving their investments in a bank. In a statement, the AG said, quote, as the former CEO of Celsius, Alex Mashinsky promised to lead investors to financial freedom, but led them down a path of financial ruin. Celsius entered bankruptcy proceedings with less than $2 billion in crypto assets, far from the nearly $5 billion it owed users. James seeks to ban the former CEO from working in the securities industry or as an executive in New York State and to have him pay for damages. Mashinsky did not immediately respond to CNBC's requests for comment. The suit was brought under the Martin Act, which gives state prosecutors widespread authority to investigate securities fraud. All right, on to our main story. Sticking with Celsius, a new ruling could make customers last in line to collect funds from the bankrupt crypto lender. A U.S. bankruptcy judge ruled earlier this week that Celsius owns most of the crypto that customers deposited.
Coinbase is cutting a fifth of its workforce to right-size its business for the bear market. The crypto exchange plans to slash about 950 jobs, and it's the second round of sweeping layoffs the company's announced in the past year. Back in June, Coinbase cut 18% of its staff, saying the company grew too quickly during the bull market and that it needed to manage costs. In a phone interview with CNBC, Coinbase's CEO Brian Armstrong partly blamed the implosion of FTX for the latest round of layoffs. The cuts will bring Coinbase's operating expenses down by 25%, and the company said it expects losses to be within the $500 million guardrail it set last year. Coinbase's shares jumped 4.3% by noon Eastern after the announcement. Next, FTX's former chief engineer Nishad Singh is hoping to strike a cooperation deal with federal prosecutors. That's according to a report from Bloomberg, which cited people familiar with the matter. Singh hasn't been accused of anything, but he reportedly met with the Southern District of New York last week, and Bloomberg notes that in such meetings, people are usually granted limited immunity to share any information they have. Singh was instrumental in writing the software that built FTX's crypto exchange, and bankruptcy court documents show he received more than $500 million in loans from Alameda Research. Finally, Cameron Winklevoss is speaking out once again over the challenges between Genesis and Gemini. In an open letter to the board of parent company Digital Currency Group, Winklevoss claims customers of its Earn service were, quote, defrauded by Genesis, DCG, and its CEO, Barry Silbert. Winklevoss goes even further, saying that Silbert is unfit to run the company and that there is no path forward with him at the helm. DCG responded to the letter on Twitter, saying, quote, this is another desperate and unconstructive publicity stunt from Cameron Winklevoss to deflect blame from himself and Gemini, who are solely responsible for operating Gemini Earn and marketing the program to its customers. About a week ago, Winklevoss wrote another open letter in which he accused Silbert of bad faith stalling tactics over frozen funds owed to the crypto company and its customers.
We're going to look at some charts and we will be covering the following topics. Extremely low realized volatility, which historically precedes explosive market moves in both directions, with latest examples of November 2018 and April 2019. Softness in on-chain activity for Bitcoin and Ethereum, coincident with low overall market volatility and setting up a weak baseline for the new year. Drawdowns in the realized cap indicating 2022 is comfortably one of the deepest bear markets to date with respect to capital losses. Bitcoin markets are infamous for their volatility. However, in spite of this, the holiday break was exceptionally quiet. Realized volatility over the last month for Bitcoin declined to multi-year lows of 24.6%, of which there are very few instances with similar levels, marked in blue. However, all prior examples preceded much higher volatility environments on the road ahead, with most trading higher and just one from November 2018 dramatically trading lower. Examples would be the early bull market in 2012 and 13 where Bitcoin prices were between $5 and $14. Then we had the late bear market in 2015 and at several stages through the bull run in 2016. Then in November 2018, immediately preceding a 50% drawdown in 1 month. Then April 2019, prior to a rally from a $4,200 to $14,000 range in July 2019, and then finally July 2020 in the lead up to what became the 2020 and 2021 bull run to $64,000. There are even fewer historically quiet periods for Ethereum, which has seen monthly realized volatility collapse to 39.8%. All primary instances of similarly low market volatility also preceded extreme volatility, with November 2018 a negative 58% sell-off and July 2020 being the primary examples. Shifting our focus into the on-chain activity space, we can see that a short-term burst of Bitcoin new addresses occurred followed the FTX fiasco, but has since cooled off noticeably. The monthly average in red of new addresses is returning towards the yearly average baseline in blue, indicating that network usage is yet to establish a convincing and sustained recovery. The momentum of on-chain activity metrics is a powerful tool to monitor a recovery in network fundamentals, with the 2019 and 2020 period being a key example from the past. Despite this short burst of address activity, the total USD value processed by the Bitcoin network has been in free fall. Daily transfer volume has collapsed from the 40 billion heights in Q3 of 2022 to just 5.8 billion a day currently. This returns daily settlement volumes to pre-bull 2020 levels and largely indicates an expulsion of institutional-sized capital flowing across the network. We can see this in the relative breakdown of transfer volume, where the dominance of 10 million plus size transactions has been a primary contributor to the decline. Large size transfers have fallen from 42.8% dominance prior to the FTX collapse to just 19% today. This suggests a significant lull in institutional-sized capital flows and perhaps a serious shaking of confidence occurring amongst this cohort. It may also reflect, in part and sadly, an expulsion of the questionable capital flows associated with the FTX Alameda entities. Demand for Bitcoin block space continues to remain weak. With negligible upward pressure on the Bitcoin fee market, the 4-year Z-score of miner revenues is yet to make any noteworthy progress back towards positive territory and remains a negative 0.67 standard deviation below the mean. This quiet on-chain activity can also be seen in the compressing USD denominated exchange flows for both Bitcoin and Ethereum. The chart here presents inflows positive VE and outflows negative VE for Bitcoin orange and Ethereum blue related to exchange entities that we are monitoring. Bitcoin inflow volumes are currently between 350 million and 400 million per day, which are a far cry from the multi-billion-dollar levels seen throughout 2021 and 2022. Also of note is the expanded scale of Ethereum exchange flows, which have grown from just 30% dominance up to May 2021 to 42% today. Now, Ethereum remains quiet. The Bitcoin network is not alone in experiencing this extremely light on-chain utilization, with the average gas price paid on the Ethereum chain remaining near cycle lows. The mean gas price since September has ranged between 16 and 23% GUI, levels last seen during the June-July 2021 consolidation and in May 2020 shortly after the COVID market panic. Breaking down gas consumption by sector, we can see that several domains are declining in their relative gas consumption dominance. MEV bots, bridges, DeFi protocols, and ERC20 tokens. Between September 2020 and September 2021, these four sectors represented a combined 45.5% of gas consumption, with DeFi protocols commanding the majority of this. Today, however, these four sectors represent for less than half of their peak dominance and account for 22.6% of the network gas consumption. The sector which has seen a recent influx of activity and attention are NFTs, which dominated gas consumption throughout 2022 and have recently increased from 13% to 22% dominance. By and large, the leading NFT markets and projects have maintained a primary foothold on the Ethereum main chain, and as yet, there has not been a notable migration of existing NFTs towards bridges and other chains. This is potentially a result of several high-profile bridge hacks throughout 2022, as well as lower gas fees on main chain at present. The realized cap remains one of the most important metrics in on-chain analysis, providing an elegant tool to monitor capital inflows and outflows from digital assets. The underlying assumption being that when coins transact, their value is price stamped and thus avoids valuing long-lost coins like Satoshis. Whilst not perfect, the realized cap is arguably one of the better tools available to measure true capital inflows, to compare valuations between assets. It acts to both filter out lost coins, partially account for volume churn, where the same coins constantly transact, and better reflects the true invested value by the market. With this as context, the Bitcoin realized cap has declined by 18.8% since the all-time high. representing a net capital outflow of $88.4 billion from this network. This makes for the second largest relative decline in history and the largest in terms of USD realized losses. This resets the realized cap to May 2021 levels, expelling all invested value throughout the second peak of H2 2021. The Ethereum realized cap has drawdown by an even larger relative scale, declining by 29.2% since the all-time high set in January 2022. Ether investors have locked in a total of $67.1 billion in net realized losses over the course of 2022. This also puts the prevailing bear market at the worst in history on a USD denominated realized loss basis, but not yet on a relative scale, eclipsed by the 2018-2019 bear market at a 35.8% drawdown. Finally, we close with a new interpretation of market dominance aimed at addressing some of the aforementioned shortcomings associated with market cap dominance. The principal issue with the widely used Bitcoin dominance metric is that the market cap of relatively illiquid tokens are prone to manipulation, such as FTT and others supported by the FTX entity. As such, entities with large and often illiquid stakes can support inflated valuations on paper, but which diverge significantly from underlying market realities. This model is the simplest implementation of realized cap dominance, which is a counterpart to the more traditional market cap dominance. It is designed to track the relative structural capital inflow outflows across two major and most liquid digital assets, Bitcoin and Ethereum. The principle can be applied to any basket of coins and tokens to track structural changes in dominance, better reflecting real capital flows and discounting illiquid supply, such as unvested token allocations, protocol treasuries, or lost supplies. In summary, the 2022-2023 holiday period has been historically quiet, and it is rare for such conditions to stick around for long. Past occasions where Bitcoin and Ethereum volatility was this low have preceded extremely volatile market environments, with past examples trading both higher and lower. On-chain activity for the two majors remain extremely weak. Despite a short-term bump following FTX, using both on-chain activity and realized cap drawdowns, it is safe to say that the excesses of H2 2021 has been largely expelled from the system. This process has been painful for investors, however, has brought market valuations closer to their underlying fundamentals.